What if I told you the modern financial world, with its booms and busts, its promises of easy money and its shocking collapses, was all born from a single audacious lie? Not in the 20th century, not with the dot-com bubble or the subprime mortgage crisis, but over 300 years ago, an era of powdered wigs, sailing ships, and a company whose name promised immense riches from a land of unimaginable treasures, the South Sea Company. It was supposed to be a company that would solve the nation's debt crisis and turn common people into millionaires overnight. Instead, it became a national obsession, a market-wide mania, and ultimately, a fraud so vast it brought an entire empire to its knees. A fraud so successful, it didn't just bankrupt a few investors. It nearly bankrupted Britain itself. But the real story isn't just about a stock market crash. It's about a hidden truth. How an obsession with easy profit can blind even the most powerful men in the world, and how the same patterns that destroyed empires centuries ago are still playing out in our world today. The question is, why do we keep falling for the same tricks? To understand the South Sea bubble, we must first go back to a nation on the brink. The year is 1720. Great Britain, fresh off a series of expensive wars with France, finds itself crippled by a staggering national debt. The war debt, accumulated over decades, was a mountain of IOUs held by thousands of private citizens. This debt was a political and economic nightmare. Enter the South Sea Company. It was established a few years earlier, in 1711, not as an honest trading company, but as a brilliant, if utterly cynical, solution to this debt problem. The company's sole purpose was to persuade the government's creditors to exchange their high-interest war bonds for shares in the company. In exchange for this, the company would be granted a monopoly on all trade with South America, a vast, untapped market believed to be overflowing with gold and silver. On paper, it was a genius move. The government gets rid of its debt, and the South Sea Company gets a license to print money. The catch? The British were at war with Spain. The Spanish controlled most of South America and had no intention of allowing British merchants free rein. The trade was a fantasy, a pure lie, but the public didn't care. They believed the company's promise of vast wealth from a continent of unimaginable treasures. The key figure in all of this was John Blunt, the company's director. Blunt, an ambitious and ruthless opportunist, knew the company was a sham. He didn't care about trade. He cared about the share price. The game was to get the price of the company's stock so high that the directors could sell their shares for a fortune before the whole thing collapsed. The government, desperate to offload its debt, was a willing accomplice. But how did a company with no real business turn into the most valuable corporation in the world? The story of its meteoric rise is a masterclass in psychological manipulation. The year 1720 was a turning point. A bill was passed that would allow the South Sea Company to fully assume the national debt. This was the rocket fuel. The promise of the South Sea's monopoly and the government's endorsement sent the share price soaring. The frenzy began slowly. In January, shares were trading at around £120. By March, they had nearly doubled to £200. The public, seeing the early profits, began to pour their life savings into the stock. By May, the shares were at £550. And by July, they hit their peak, an astonishing £1,050 per share, a nine-fold increase in just 7 months. The entire nation was caught in a speculative fever. Dukes and duchesses, merchants and servants, all scrambled to buy shares. People mortgaged their homes, sold their land, and took on enormous debt to get a piece of the action. The price had no connection to the company's actual business. It was driven purely by greed and the greater fool theory, the belief that you could always find a bigger fool to sell your shares to at a higher price. The directors fueled this madness with public displays of wealth, lavish parties, and a constant stream of lies. They even bribed members of parliament and the king's household to endorse the company. This created an illusion of safety, a feeling that this time it was different. This time, the bubble would never burst. The bubble reached its zenith in the summer of 1720, but the very success of the South Sea Company created a new problem. Inspired by its rapid rise, dozens of new bubble companies popped up overnight. These companies, with names like the Company for a Perpetual Motion Machine and the Company for Carrying on an Undertaking to Great Advantage, but nobody to know what it is, were even more ridiculous and serve as a canary in the coal mine. The South Sea Company, fearing the competition from these smaller scams, panicked. They lobbied the government for the Bubble Act, which would forbid all other new companies from raising capital. It was meant to protect their monopoly, but it was a fatal mistake. The act was passed, but it also sent a clear signal to the market. Something was wrong. If the biggest company in Britain had to resort to government force to stop its rivals, what did that say about their own business? The confidence began to crack. Investors, seeing the smaller bubbles pop, began to sell off their South Sea shares. What started as a trickle became a flood. The share price, which had soared over £1,000, began a terrifying descent. By September, it had plummeted to £150. By December, it was just £124, a devastating 88% crash from its peak. The nation was in ruins. Thousands of people, from the wealthiest to poorest, were financially wiped out. Suicide were common. Fortunes made in months vanished in days. The fraud was exposed, and the public demanded vengeance. The political fallout was immediate and immense. Parliament launched an investigation. The public outrage was so severe that the directors of the South Sea Company were jailed, and their personal estates were confiscated. They discovered a web of corruption so extensive it reached the highest levels of government, even implicating the king's mistresses. But the government's attempts to fix the mess were largely symbolic. They passed a law to fix the problem by distributing some of the directors' seized wealth to the victims. But the money was a drop in the ocean compared to the billions lost. The government's main goal was to preserve the financial system and prevent total collapse, not to restore everyone's wealth. It was a failure. The crisis left a permanent scar on the British financial psyche, leading to a profound distrust of corporations and speculative markets for decades to come. The real solution, the creation of a modern, more regulated financial system, would take centuries to fully materialize. The South Sea Bubble isn't just a historical footnote, it's a template. The same patterns of hype, greed, and eventual collapse repeat themselves over and over, from the roaring 20s to the dot-com bubble and the subprime mortgage crisis. The parallels are chilling. Think about it. The South Sea Company promised vast, untapped riches from a distant land. Dot-com companies in the late 1990s promised to revolutionize the economy with new technology, with no actual profits. In both cases, the valuation was based on a fantasy, not on fundamentals. The South Sea directors bribed officials. In the lead-up to the 2008 crisis, mortgage lenders and investment banks were paying off rating agencies to give their risky products a safe rating. The mechanisms are different, but the principle is the same: corruption and self-interest. And perhaps most importantly, the psychological element remains identical. The fear of missing out, FOMO, drives people to invest in things they don't understand. The belief that this time it's different blinds them to the obvious risks. The South Sea Bubble proves that human nature hasn't changed. We are still a species obsessed with shortcuts to wealth, susceptible to manipulation, and always on the hunt for the next big thing. So, what can we learn from the South Sea Bubble? 3 key takeaways stand out. Valuation is a choice, not a fact. A company's value is only what the market is willing to pay. When that valuation is based on hype and not on fundamentals like profits or assets, it's a house of cards waiting to fall. The price of a stock doesn't reflect the truth. It reflects a story. Trust is a currency. The South Sea Company's greatest asset was not its monopoly, but the trust it cultivated with the government and the public. When that trust was broken, the entire system collapsed. A sound financial system is built on faith, and that faith is fragile. Human greed is the oldest financial pattern. Bubbles are not economic phenomena. They are psychological ones. The desire for easy money, the temptation to jump into a market that is always going up, is a trap that has snared investors for centuries. The South Sea Bubble didn't just teach us about market collapses. It taught us about ourselves. It was a dramatic warning sign etched into the pages of history, reminding us that the greatest risks aren't found in the market itself, but in the human heart. The question isn't if another bubble will form. It's when, and whether we will finally learn from history. If you want to dive deeper into the forces that shape our financial world, hit that subscribe button and ring the bell. In our next video, we'll explore another historic financial event that changed the world forever. Let us know in the comments below which financial collapse you want to see us cover next.